Implied volatility is effect on an options, strike distance, and break even. Do you think implied volatility has an impact on the strikes you select?
No.
That's ridiculous to say that. No.
The individual implied volatility of the strikes?
No. Do you think implied volatility in general?
In general, of course. So we only look for high IVR. I mean, that's what we do. I thought you meant like granular enough down to the strike itself. You're going to have wings that are going to have a lot higher implied volatility than the strikes I'm going to sell. Individual.
Okay. Let's take a look. Implied volatility has a huge impact.
It's the only thing we look for.
On things like break even and things like that. So let's have let's check it out. So strike distance is the distance between the strike price and the underlying price. The break-even ratio, on the other hand, aids in calculating the price movement required for your option position to break even, taking into account the strike price and the option premium. Now, the question arises, does a change in implied volatility affect the strike price and the break-even ratio for both the call and the put options?
The break-even ratio?
It's a little complicated, but yes.
Calculating the price.
It's just the break-even ratio is all it is a way to calculate.
Yeah, I don't know.
It's hard. I wouldn't expect. I wouldn't know either. Okay, to be fairly. Yeah. But what you're going to see is, and this is a really interesting piece of research that the team did. And I just spoke to Gad because I wanted to make sure I understood this completely. That's why it took us a couple extra seconds to get here. But we've never calculated this ratio before. And what the team's showing is that you can actually, in higher implied volatility, your put strikes widen out tremendously, and your call strikes don't hurt you that much. I mean, it doesn't move that much. Let's go to the next slide. So, and this is the heavy part right here. In this study, we will use the formula below in calculating the parameters. The strike distance, and again, we're just, okay, we'll call PS the put strike price, S the stock price, and CS the call strike price. And here's where it gets a little confusing, Tony. The break-even ratio. For call options, the break-even ratio is K divided by K plus the option premium. So K being the strike price. Okay. And for put options, it's the strike price divided by the strike price minus the option premium.
Look at the big brain on Gad and Kai.
Yeah. So K is the strike price. So it's K divided by K minus option premium. So it's two different ways to look at it. Let's go to the next slide. So 16 delta strangles, 13 years worth of research, 45 days strangles. This is only in SPY, so it's going to have put skew. And managed at 21 days. We computed the buying power, the strike distance, and the break-even ratio. And then we looked at the results as implied as the VIX changes. Let's go next slide. So first, this table illustrates how the strike distance behaves as implied volatility increases. So negative value in call options suggests that they move in the opposite direction compared to put options, but they possess the same value. Okay, because that's just skew. So we looked at three ranges for the VIX: under 15, between 15 and 25, where we are right now, and over 25. And as you can, first column, you can see the buying power. The buying power is less when volatility is high. I know that seems weird because it's the opposite of futures options, but the reason that happens is because you collect more premium, so it reduces your buying power requirement. K is the strike price, so you're able to use different strike prices, actually go way higher strike price when volatility is higher. And then the option premium, of course, goes up as volatility goes higher. Even though you've already adjusted by strike price, your premium's still higher. And then that's why what we're trying to show here today is why vol at these levels was so attractive, even though it's come in, just a little bit. And where am I? Okay, so the distance for put options, and here is a super interesting. I'm not sure.
Sold your MBT.
Oh, I sold the MBT. That's interesting because I had that offer in at 35,000. So now we're going to go to /
It's up 1,050. Yeah, 35,005. You're right there.
/ ET. Okay.
Correct.
So now we're going to done. Okay. So just so I don't want to confuse.
You did 3 to 1. You're all good.
Yeah, so I don't want to confuse anybody. But what I did was I just bought 5 Ethereum coins.
You bought one, which equals
No. I bought one future. I'm just explaining what I did. I bought 5 Ethereum coins, and I sold 3/10 of a Bitcoin. 3/10 of a Bitcoin is about $10,000, and 5 Ethereum coins is about $10,000. And I'm assuming the volatilities are equal, so I'm selling Bitcoin here, buying ETH. It's a pairs trade, highly correlated underlying pairs trade. We'll give it a shot. Last week, one of our viewers called in and wanted us to do the trade. I didn't do the right ratio, so I took it off, waited till today, and got it on at much better price. So we'll see what happens. We'll watch it close. It's a small trade. I only did it 1 by 3, and so we'll see what happens. Okay. I just wanted to be very clear and open about exactly what I did. So negative.
It's all on the follow page.
Negative values in the call options suggest they will move in the opposite direction. I already went through this. So the first most important takeaway here is that the difference is when volatility is low, below 15, the distance for put options is 7 points in the SPY, 7 strikes. When it's over 25, the same distance, 21. Huge difference. Right now, we're in that 12 range. So that's why you want to be, putting positions on right now, because it's attractive. Second thing, difference for put options. Difference for call options. Now, this is what's really interesting. The call options, that's the difference for put options, but the call options, same thing. So there's not this dramatic change from calls to puts. All right, let's go to the next slide. First takeaway. So rising implied volatility can boost the strike distance of both the put and call options. This happens because higher volatility suggests a higher potential for significant price swings in the underlying asset, increasing the chances of an option becoming profitable. This is why when puts go up in value, calls go up in value. And when calls go down in value, puts go down in value. Just this explains the whole thing. And a greater strike distance indicates a more advantageous position for the option seller, typically because the underlying stock's price is moving closer to or further below the put or call strike price. This is beneficial for the option seller as it reduces the amount of buying power required to maintain the position. However, it's important to remember that the strike price of the put and call option remains fixed once the contract is established. Again, my biggest takeaway here is this explains to people why when the market goes, when there's something happening, okay, and your call option is going up, you're wondering why your put option is going up, that's why. When your call option is going down, you're wondering why your put option is going down, that's why. Next slide. So this table illustrates how the increases in implied volatility can impact the price movement required for your position to break even. Now, this is, again, really super interesting. Same volatility ranges, same strike adjustments, same premium as the last slide. But with this one we did is we took a ratio. And we took the ratio for call options, which we showed you on the prior page, which we showed you on the second slide, and the ratio for put options. And what we did here is we showed that in order to break even, okay, in the call options remain the same. Okay, so the call options never change when volatility does whatever, because the ratio is going to stay the same. But for put options, okay, it gets the movement required is significantly less. Okay, so it changes the dynamics of a trade. So it's just a break-even ratio. Like, how much does the underlying have to move in order for this option to get to? What it shows you is that if you're going to sell premium, you have such an advantage when implied volatility is high. And we'll explain it more in the next slide. Go to the next slide. So implied volatility has distinct effects on call and put options. In the case of call options, the break-even point remains stable with increasing implied volatility as the higher premium is offset by the potential for higher price swings. On the other hand, for put options, the break-even ratio decreases with rising implied volatility, meaning it making it easier to reach your break-even point. This is due to a combination of higher premiums and the greater potential for price swings in the underlying. So option traders should be aware of these dynamics to effectively manage their position based on market outlook and strategy. Next slide.
And they use this all on ETFs, right? Is that what they're...
Just the SPY.
Yeah, right.
So For premium sellers.
You're not going to get this phenomenon in an equity. You might actually see something.
No, it's going to be different. It could be the opposite.
Yeah.
For premium sellers, it's crucial to consider implied volatility when writing options. Rising implied volatility can increase the strike distance of both put and call options, making them more likely to be profitable and reducing the buying power for option sellers. Conversely, call options tend to maintain stable break-even points with increasing volatility, offering some stability for premium sellers. Understanding these effects is vital for effective risk management and aligning strategies with market conditions. It's a little heavy.
Little heavy, but nice job by the team.
Yeah.
Very nice. We're going to take a quick 90-second break and come back. We got more Tasty Live coming up next with a market measure. Even the S&P's up 36.